This video will cover basic topic on bookkeeping. So, let's start with defining accounting. What is accounting? Accounting is the process of recording financial transaction pertaining to a business. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. It identify, record, and communicate the economic events of an organization to interested users, and then analyze and economics events relates to business transaction. The accounting process includes the bookkeeping function. Identifying transaction involves determining if transaction exists and whether it is a monetary transaction related to business. Recording transaction involves entering the accounts as a debit and credits for each individual transaction. This process is called posting a journal entry. Communicating the recorded transaction involves preparing accounting reports. These reports summarize the information obtained from all the stages of accounting process, including identifying, quantifying, recording, and classifying economic transactions, so that interested users can use it to make sound decisions. Analysis and interpretation refers to a systematic and critical examination of the financial statements. It not only establishes cause and effect relationship among the various items of the financial statements, but also presents the financial data in a proper manner. Who uses accounting data? There are two types of interested users who use the accounting data: internal users and external users. Internal users are management, human resources, finance, marketing. An example of internal user is when hiring manager makes a decision whether it is cost-effective to hire a bookkeeper or outsource a bookkeeper. External users are customers, Security Exchange Commission, creditors, labor union, investors, and IRS. An example of external user is when creditors wants to find out if the company they are interested in lending money to has a good credit rating. What type of users ask the following questions? Can we afford to give our employees a pay raise? Human resources, they want to make a decision whether they are in a position to give their employees pay raise. Human resources are internal users. Did the company earn a satisfactory income? Investors, investors are external users. They usually ask if a company made profit to decide whether to invest money in the company. Do we need to borrow in the near future? Management, they are internal users. Management usually ask this question to make decision so they can better manage cash flow of their company. Is cash sufficient to pay dividends to stockholders? Finance department is internal users. Finance department of the company usually ask this question because they can make company budget accordingly. What prices for our product will maximize net income? Marketing department is an internal user. Marketing coordinator wants to find out which product will more profitable so he can promote it more often. Will the company be able to pay its short-term debts? Creditors are external users. They usually like to know if the company can pay its debt so they can make a decision to loan it money. Let's go over basic accounting equation. Assets equal liabilities plus owner's equity. This equation provides the underlying framework for recording and summarizing economic events. What are assets? Assets are resources a business owns. It provides future services or benefits. Examples of assets are cash, supplies, equipments, etc. What are liabilities? Liabilities are claims against assets. Creditors are party to whom money is owed. Examples of liabilities are accounts payable, notes payable, etc. What is stockholders' equity? Stockholders' equity is ownership claim on total assets. It is referred to as residual equity. Example of stockholders' equity is paid in capital, retained earning, etc. Investment by stockholder increases stockholders' equity. Dividend to stockholder decrease retained earning. Revenue result from activities entered into for the purpose of earning income. Common sources of revenue are sales, fees, services, commission, interest, dividends, royalties. Expenses are the cost of assets consumed, or services used in the process of earning revenue. Common expenses are salaries expense, rent expense, utilities expense, tax expense, etc. Dividends are the distribution of cash or other assets to stockholders. Dividends reduce retained earnings, however, dividends are not an expense. Barone's repair shop was started in May of 2000. Let's prepare a tabular analysis of the following transactions for the month of May. Stockholder invested $10,000 cash to start the repair shop. $10,000 investment increased cash by $10,000 and increased common stock by $10,000. Next, the company purchased equipment for $5,000 cash. The company acquired equipment which increased the equipment by $5,000 and it paid cash, so cash account was decreased by $5,000. Next, company paid cash for office rent for $400. It is an expense. The company paid the expense with $400 cash, so it decreased cash by $400 and decreased retained earnings by $400. Next, the company received $5,100 from customer for repair services. The company provided services, so revenue was increased by $5,100. It received cash for the service, so cash was also increased by $5,100. Next, company paid dividend of $1,000 cash. It paid the dividend with cash, so cash was decreased by $1,000 and stockholders' equity was also decreased by $1,000. Next, the company paid salaries to its employees for the month of May for $2,000. This is an expense. The company paid expense with $2,000 cash. So cash was decreased by $2,000 and retained earnings was decreased by $2,000. Next, company paid for advertisement of its services on credit for $250. This is an expense. Company spent $250 for advertisement on credit, which increased accounts payable by $250 and retained earnings decreased by $250. Next, company provided services on account for $750, so accounts receivable increased by $750 and revenue account was also increased. Next, the company received cash for services it performed previously for $120. So cash was increased by $120 and accounts receivable was decreased by $120.